Hello, and thank you for watching. I'm Rahul Bardwaj, the President and CEO of the Institute of Corporate Directors. As Canada and the world grapple with the implications of the COVID-19 pandemic, the ICD is producing a series of webinars and webcasts that focus on critical areas of governance that will help directors navigate the challenges in the weeks and months ahead. Today, we are discussing the economic implications of the pandemic, which are vast and all-encompassing. Along with the health and safety of employees, this is the top agenda item for every board of directors in Canada and most likely the world. But what comes next? How will we know when we are emerging from this fog, and what can we expect? To discuss this, I'm pleased to be joined today by Craig Alexander. Craig is one of the top economic minds in Canada. He is the chief economist for Deloitte Canada and a former chief economist for both TD Bank and the Conference Board of Canada. Welcome, Craig.
It's a pleasure.
Craig, let's start with a bit of an optimistic question. What indicators are you watching to give you a sense of where the global and Canadian economies may go as we enter these different phases of the crisis? And when would you start to feel confident that we're starting to come out of the woods?
So this is a very different economic environment than we've ever had before. If we think back to other economic downturns, you always had a period where things were decelerating even before the recession took hold. So like back in 08-09, we actually saw the economy decline, the US economy slowing for 4 quarters before the recession actually hit, and we ended up in the financial crisis. This time around, the economy plunged because policymakers have literally unplugged the economy in order to contain the spread and then stomp out the COVID-19 virus. So it's a very different environment. I think that means you also have to look at different indicators than you normally would look at. So one of the things that Deloitte set up was a recovery dashboard, and you can find this on our external, the Deloitte.ca landing page. And what it does is it actually has exactly what I'm looking at. So first and foremost, looking at health statistics. This is a health crisis. We'll know that things are turning when we're actually seeing the bend in the curve in terms of the number of net new cases. In fact, we're already seeing part of that in Canada, like in certain provinces like BC and Alberta and Manitoba, and I think potentially Quebec. We're actually seeing signs that the number of net new cases is rising at a slower rate. In some of the other provinces, we haven't mastered it yet. So number one, health statistics. Number two, a lot of the economic indicators that I typically look at are very lagged in this environment where StatsCan is reporting a month or two behind. So like we know the economy plunged in March, but the economic data we're getting is for January and February. So that's one of the limitations of the traditional metrics. But there's lots of really high frequency data out there that's not your traditional economic metrics. So in our dashboard, we have things like the number of cars in parking lots, how much foot traffic is there at retail outlets, how much congestion are there on roads. Like right now in Toronto, our traffic congestion is 16% of normal. Well, if we look at Singapore, they went down to 16%, but they're now back at 80. So I think these sort of really high frequency indicators are probably going to tell us the turn before the traditional metrics. And then the other two things in our dashboard are financial indicators like the shape of the yield curve, equity markets, the VIX, which is a measure of volatility, financial market volatility. And those, again, are starting to show signs that the tide is in fact starting to turn. And then we get into the economic indicators. And on that front, there are some that are more timely. So for example, I spend a lot of time looking at purchasing manager indexes because I think they're released sooner than most other indicators.
Interesting. Now, you mentioned Singapore. It just reminds us that this is truly a global event. In fact, some have argued that this crisis has actually created the apex of globalization. We used to assume that globalization was like a little bit like a genie that couldn't be put back in the bottle, but this crisis is testing that thinking. And I'm thinking that following the Trump 3M calamity, you wrote about the prospect of returning to what you called industrial sovereignty. What did you mean, and what would be the economic and trade implications of such policies?
Yeah, I think we have to be mindful that in the wake of the current environment, we're going to probably see significant changes to global supply chains. And some of that was actually already happening in the wake of the rise of nationalism and protectionism that manifested in things like the Trump China trade war. Suddenly, businesses were starting to be aware that there was increased political risk and vulnerability. But then we had the epidemic, and this has really shaken global supply chains. It's caused businesses to rethink about, sort of where they're sourcing their inputs and where they're selling. So there could be impacts from that. Then, as you said, there was the 3M incident where Trump raised the possibility that Canada might not be able to get essential medical supplies, and kudos on the company for basically standing up and making it public that this was a discourse that was taking place, because ultimately I think the general sway was to resist that temptation, and in fact it did. The market did remain open, but it highlighted the vulnerability. And I think that what could happen in the wake of this is that you could see some repatriation of supply or production chains of essential goods. But then I get worried that once you start down that path, that could actually lead you to an even greater move towards protectionism, where for example, and I'm not trying to be critical of this, but the Quebec government said that they were going to be putting in place programs that were to incent businesses to relocate activities into Quebec, and it wasn't just essential medical; it was also food. And then so then you start to ask your question, okay, well, maybe food and medical supplies make sense, but what if this keeps going? What if you have a push towards doing that on a broader range of industries or activities? And understand that while globalization created problems in terms of rising inequality in the advanced world, globalization was also a fundamental source of creating cheaper products and more efficient production. So from an economic point of view, we need to resist the urge of a de-globalization movement.
Mhm. Now, of course, COVID isn't the only crisis facing the Canadian economy. Outside of Alberta, depressed oil prices aren't getting the attention they normally would, but this is a huge deal for the future of the Canadian economy. A recent détente between Saudi and Russia hasn't seemed to make much of a dent in oil prices. Is there any reason for optimism in Canada's energy sector right now?
Well, as you said, the Canadian economy is being buffeted by both the fallout of the pandemic and its economic distortions, but also a very big oil shock. And the oil shock was compounded when there was a failed OPEC meeting in March. Now, just the other day, OPEC and other countries announced that they were going to significantly, and in a historic way, lower supply. They announced 9.7 million barrel per day supply reduction from the OPEC and associated members. And then you're going to get also reduced supply from Canada, the United States, and other countries from a market point of view. But oil prices didn't rally on that news. And the reason is because of the amount of demand destruction that's taking place because of a very severe recession. Even with these supply constraints, I think you're still going to see inventory levels rise in the coming days. And we're already pushing up against inventory supply capacity. And so that means that probably in the second quarter, heading into the third quarter, we're probably going to continue to have exceptionally low oil prices. And then I think as gradually containment is lifted in the advanced world, as a recovery takes hold, I think you will start to see oil prices rise, but they're still going to have this hangover from the very high inventory levels. So we think that oil prices are probably going to remain sub $30 in the through the summer, and then in the fall, heading into the winter, we think it'll probably get up into the sort of $35 to $39 range. And of course, Canada is also being impacted by the spread between the benchmark price, which I was just quoting, which is West Texas Intermediate crude, but also Western Canada Select. Last week, Western Canada Select was selling at $3. Its trough was $3.82. In point of fact, you could buy a barrel of oil in Alberta for less than a Starbucks latte, and that tells you just how big this shock is to the oil and gas sector. So it's going to be really difficult times. You're going to see reduced investment. You're going to see downsizing. You'll see distressed M&A activity in the energy patch. I have been waiting
Yes.
for the federal government response to support the energy sector. They said a package was coming to tackle some of the weakness in the energy sector. They said it would take, it would be coming in days, or hours, if not days. But unfortunately, that was 2 weeks ago.
Right. Let's pick up on that theme about the government response, which has largely been pretty massive and quick in some respects. And globally, markets have responded somewhat positively. Are there other initiatives you'd like to see the federal or the provincial governments be considering now?
Yeah, so the initial response by the federal government was to focus on the two things that mattered most, which is number one, the shock to personal incomes. So if you tell people to stay home from work, stay home to be safe, then you've actually got to give them the income so they can do what you're telling them to do. The second shock is to business balance sheets and cash flows. And their response on this front has sort of been twofold. Number one, they've increased financing so businesses can get access to additional credit to get them to the other side of the crisis. And this is being done through expanded lending by BDC, EDC, and also in conjunction with the private sector chartered banks. But beyond that, the other component is the wage subsidy, the 75% wage subsidy for businesses that experience a significant drop in revenues. And that program is really important. It's more likely to keep people on the payrolls. But to be honest, I think the government hasn't done a lot on the business side, right? Even the wage subsidy, in my mind, is predominantly about keeping workers employed as opposed to helping support businesses. I'm quite worried that we're going to see many small businesses go out of business in this environment. I'm also very cognizant of, or sensitive to the fact that the single biggest risk going into this environment was the amount of leverage we had in the global economy, right? We had excessive amounts of debt because of low interest rates. And in Canada, it was manifested with excessive household debt. Corporate debt wasn't that bad, and government debt was manageable. But in other countries like the United States, it was predominantly corporate debt. And in Europe, it was a combination of corporate and government debt. Well, we're going to come out of this and we're going to have more leveraged households, more leveraged businesses, and more leverage and dramatically more leveraged governments. So that's one of the great risks coming out of this. I really, I'm not sure just having businesses borrow more is actually the solution, right? I actually think we need programs that help support hard hit industries. And it could be the case that that's just taking longer to design, and that maybe it'll come in the days ahead. We're also going to need, as governments think about how to fuel the recovery or stimulate the recovery, there are things governments are going to need to think about doing in terms of, as they relax containment, what to do to boost the economy, like boost demand, right? Like one of my top recommendations is I'd really like to see the federal government and the provinces cut their sales taxes, right? Cut GST, cut HST, cut some of the PSTs in order to stimulate demand. And you could do it on a temporary basis, but like when we come out of containment, there still will have been an income shock. And I think you're going to want to encourage businesses to go out and spend. Other creative recommendations are things like vouchers that you can only use in like local restaurants, right? Like in other words, this has been a sector that's been aggressively hit by the downturn. Well, let's stimulate them on the recovery, right? And there's things governments could do to actually direct spending into retail, into restaurant hospitality and the like.
That's very interesting. I look forward to coming back and reconnecting on some of these solutions. Very interesting. But finally, I'm going to ask you to put on your long-term forecasting hat, Craig. It seems like one of the lasting impacts of the COVID crisis will be how and where we work. It's possible that many firms see remote work as advantageous in the long term, with significant savings on overhead, etc. But how do you think these changes might play out in the broader economy? And what do directors of boards need to be thinking about planning for future purposes? And I'm thinking about commercial real estate, but also sectors like construction, aggregates, manufacturers, and such as Bombardier, that they make trains for public transit, etc. What should boards be thinking about in this environment?
So I think there's a couple of things, right? And before we do the long term, let me first say, if you have directors that are asking questions of executives, one of the questions I would be asking them is, how will the company be or institution be affected by different scenarios? Like, I wouldn't actually put my emphasis on just one base case, right? The most likely case is still that within a couple of months, the containment is going to be relaxed in some way, and then the economy will start to recover, and it'll take a long time, and we'll have a slow recovery, but we will get out of this, right? But there are other scenarios we need to be mindful of. We need to be mindful of the possibility that we come out of containment and you get a second round of infection and you have to go back into containment. You have to think about a scenario where the containment is relaxed in Canada, but America actually has a harder time. One of my number one concerns is if the US comes out of containment too soon and then they get a resurgence of the epidemic, whereas in Canada we come out of containment okay. Well, that has a very different impact on the Canadian economy and our businesses, right? In every province, we do more north-south business than we do east-west. So, what happens in the US is fundamental to what happens in Canada. So I would be thinking about different scenarios. Like, is it a V where we go down and we come back up sharply, which is the base case? Is it a U where we actually have a longer protracted recession? Is it a W where you go down, you come out, but you have a double dip? These are the things that businesses need to be thinking about, and making sure they have the cash management to be able to get through those times. So an awful lot of my work right now is working with companies doing scenario planning and cash management scenarios. But then there's the longer term. And the longer term is, it's possible that world after this is not going to go back to what it was like before, right? We already talked about the possibility of deglobalization. We've already talked about the possible disruption to supply chains, and that's very fundamental to a lot of businesses. Like, what will supply chains look like? But then there's other factors out there that could play into a different world, right? Businesses have now figured out how to do more remote work. So as you said, maybe they won't expect their employees to come back in a normal way. Maybe they're going to save space, right? I actually think that there's a high probability that there'll be businesses out there that will say, we don't need all this real estate space we currently have. We can save money by having more workers work remotely. And you know what? We figured this out for months. There's no reason why we can't make it permanent. Mm-hmm. Now, I'm not sure it's going to be like, 1 or 0, right? Like, it's going to be some mix in there. And I also think that the legacies of the environment will be a function of how bad things actually are, right? Like, so in a V, I think the world will be a little different, but in a U, where you have a really deeper, longer recession, well, I think that then the legacies will actually be bigger as well, right? Because you would have had more workers stay in 100% remote mode for a longer period of time. So it's more likely to have a lasting effect. We are seeing different behaviors, and if we look at some of the countries that have come out, like China, it's fascinating to look at some of the lessons from China. Like, a good example is foot traffic in, like, so the economy is operating about 80%, but foot traffic in the retail sector is only at about 20%. So what's happened is, they're open, but people are not coming in like they have historically. And one of the things they're noticing is that people don't want to touch products on shelves, right? They'll stand there and they'll look at the products, but they're not inclined to actually pick them up. One of the most extreme examples, which I was shocked by, was clothing stores that actually had models that would put on the clothing for you and show you what the clothing looks like. And then you buy it, take it home, wash it, put it on, and the first time you actually put it on, you don't try it in the store, right? Wow. You put it on at home, right? And so that's the different mindset. Now, keep in mind that we are still in the midst of a global pandemic. So, they are, it could be when we have a vaccine and this has passed, it could be that retail behavior changes again. But understand, for a retail outlet, it could be at least a year before we have a vaccine. And as a consequence, even when we come out of containment, you got to think, okay, so how's my business going to behave in a world where consumers don't want to go to the retail outlets as frequently? They don't want to touch products. If they go, they tend to buy more in each going because they want to make fewer trips. We've seen impacts on brand where people are buying brand names because they think that associates with quality and longer lasting product. And that means it won't wear out as quickly, which means I won't have to go back to the store as soon. right? So these are like dramatic and different things that are happening in the retail space. But similarly, more remote work. Well, it's going to impact congestion on our highways. Well, it could be that people don't take public transit, and so it could be we end up with more congestion on our highways, right? Because of that. There are a lot of potential legacies in this environment. It could be, I'm hoping businesses in this environment have figured out that they've been underinvesting in digital, and boy, we need more digital. I certainly can argue that our telecom companies, our telcos need to expand their 5G networks and improve the resilience of them, because I'm finding that at times I have weak connectivity because of the number of people that are currently using the system, right? So it ranges from every sector, right? There's implication. The new normal for manufacturing is going to be different. The new normal for commodities is going to be different. The new normal for retail and wholesale, it's going to be different, right? And so we need to be careful, because I remember in 08, 09, when the financial crash happened, people came out and said, oh, you know what, the world is going to be completely different. And yeah, it really wasn't, right?
Mm-hmm.
Like, there were some legacies. The big one was low interest rates forever. But outside of the interest rates, it wasn't really like a new normal. I think this one has a greater potential to change the psyche of individuals. I'm a big student of history. I think we are avoiding a repeat of the Great Depression because of the policy response, which has been enormous and rapid. So I don't think we'll see a depression, but I do think that we could see legacies from this environment that are reminiscent of some of the behaviors that we saw post depression. Like, I think we're going to find consumers save more money, right? I think there's going to be people that are going to say, like, I need to have more cash on hand if something terrible happens. I certainly know that there's going to be pension funds and investors that are going to need to rebuild their assets, right? Governments are going to be faced with dramatically larger deficits and huge debt loads. And because of that, I think that you got to ask yourself, like, what's going to happen to taxes? Yeah. Pretty sure taxes are going up after this, right? Government saved us, and then it's going to be, well, now you got to pay higher taxes. So how will businesses respond to a likely higher tax environment? I don't think governments are going to have money for infrastructure and other critical areas. I think there's going to be a lot more need for public-private partnerships after this, because we're going to still need the infrastructure, but governments are going to be not broke, but they're only going to have money for the most important things like healthcare and education.
That's remarkable. Well, thank you for sharing this with us today, Craig. It underscores that the new normal will be anything but normal. Thank you very much for joining us today, Craig, and thank you all for tuning in. Please look out for new installments of this series every week as we navigate this challenge together. Bye for now.